Good morning. Welcome to CATEX TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, October 3rd, 2008. It's 11:30 a.m. Eastern Daylight Time in the U.S., 4:30 p.m. in London, 12:30 p.m. in Bermuda, 9:30 a.m. in Mexico City. If you need to reach us during the broadcast, phone in toll-free at 1-866-67-CATEX. Overseas, our AOL Instant Mail address is CATEX TV. I would just like to take note that over the past several weeks, James Mills, who periodically appears as the newscaster on the show, has been serving as the show's producer. He's been doing a very good job. Today's day in history, in 1990, 18 years ago. How quickly time passes. East and West Germany ended 45 years of division and combined to really come into one country, the Federal Republic of Germany. Clive Owen, the actor from Ireland, is 44 years old today. Now to our main news. Some economic data in the U.S. Job losses are the worst in 5 years, the Labor Department reported this morning. U.S. employment fell by 159,000 during the month of September, the worst month since March of 2003. The unemployment rate was steady at 6.1% as expected. However, an alternative measure of unemployment that includes discouraged workers, people who actually have given up looking for jobs, increased by 0.3 of a point up to 11%, which is the highest since April of 1994. The American economy has now lost over 750,000 jobs this year alone. And now, if we can play the bugle and the trumpet of the cavalry coming, the bailout bill is wending its way back, and the stock market's aware of it. It's up about 211 points right now. It's still unclear, though, whether House leaders will have the dozen or so supporters needed to pass the measure. The plan likely to be voted on in the House tonight, is the one that will allow the government to spend billions of dollars to buy bad mortgage-related securities and other devalued assets from troubled banks. If it works, advocates say that it would allow frozen credit to begin to flow again. African American lawmakers in the House of Representatives said personal calls from Barack Obama have helped him switch from a no to a yes vote. Republicans and Democrats alike are saying that phone appeals from credit-starved small businessmen, as well as the Senate's addition of $110 billion in tax breaks in their version, have now persuaded many of them to drop their opposition. And I hate it, but inaction to me is greater danger to our country than this bill attitude seems to have taken over. 133 House Republicans voted against the bill. 95 Democrats voted against the bill on Monday. Apparently now they're beginning to pick these people off one by one. Congressman Steny Hoyer, a Democrat who's the House Majority Leader, said that he's not going to bring the bill to the floor unless it has a good prospect of being approved. And his counterpart, the Minority Whip in the House, Roy Blunt of Missouri, the Republican, said that he predicts that the measure will be approved. Of course, yesterday President Bush announced that a lot of people are watching. So we'll keep our fingers crossed on that. Obviously, if the market is any guide, they're thinking it's going to pass. Some banking news today. Wachovia, the country's fourth biggest bank, in the beginning of this week was going to be purchased by Citibank. Citibank has now been usurped by Wells Fargo. They're going to come in a $15.1 billion all-stock deal. They're going to wipe out Wachovia's previous plan to sell its banking operation to Citigroup. A key difference is the Wachovia deal will be done with Wells Fargo without government assistance, while the Citigroup deal would have been done with the help of the FDIC. Now, Robert Steele, Wachovia's president, says this deal enables us to keep our bank intact and preserve the value of an integrated company without government support. The deal was announced this morning. Wachovia shareholders will receive slightly less than 1/5 of a share of Wells Fargo stock for every share of Wachovia that they own. This would value Wachovia at about $7 a share. Yet last night, Wachovia shares closed at $3.91, so this is an 80% premium. We're finally beginning to get some more definition on the AIG deals that they're planning to spin off so they can raise some money. Edward Liddy, the AIG CEO, had a conference call this morning with investors, and we now have some information as to what he told them. AIG has apparently already drawn down $61 billion from the federal credit facility. This is as of the last day of September. AIG plans to retain its American property and casualty as well as its foreign general insurance business, and they're going to continue to retain an ownership interest in its foreign life insurance operations. This morning, Liddy said, quote, "We are refocusing on our traditional strengths in P&C underwriting." He went on to say that the company is exploring selling the remaining businesses. Furthermore, we will sell as many assets as needed to repay our obligations. He went on to say that this is not a fire sale. He confirmed that they would prefer to sell a minority stake in their aircraft leasing operation and retain a majority stake, but he emphasized that he would continue to have flexibility there. He said, "We'll focus on retaining the U.S. P&C operations and also retaining an interest in the foreign life insurance. We will tilt our prices to larger transactions. We will have a bias toward selling our operations to brand name companies with strong balance sheets. We will look favorably on preemptively priced offers." So he did say it's not a fire sale, but he also said that if you call him up with a nice offer, he'll take it. More information will come out on this. The wires are just beginning to run as I came on the air, but the conference call apparently ended at about 9:20, a little bit before the stock market opened. Some more companies are coming in with reports of the storm losses over the past 5 weeks. ACE down in Bermuda announced today that their estimated net after-tax losses in Q3 from catastrophes such as Gustav and Ike will amount to about $315 million U.S., including reinstatement premiums. Also, Everest Re came in saying that their losses from Gustav and Ike will be about $200 to $220 million. It's a front-page story in today's Insurance Day written by reporter Liz Booth that is actually somewhat interesting. We'll read it to you in its entirety. This week's round of professional indemnity renewals have given insurers some hope of a market turnaround amid warnings that Lloyd's is ready to intervene if premium rates continue to decline. Prices at the October 1 renewals are reported to have remained at last year's levels with only very small increases. These renewals, of course, are coming at a time when P&I insurers are facing a warning to stop that race downwards or else face the possibility of a reduced capital base. Lloyd's franchise performance director Ralph Tolley is reported to have met with London-based P&I insurers to issue a warning that unless things change, Lloyd's will consider controlling the amount of capital allowed into the market. Details of the meeting have begun to emerge. This was a forum held in London over the past few days. A gentleman named Xavier Villers, who's a director at Miller's Insurance, warned attendees that prices might increase. Speaking about Lloyd's and commercial P&I, Villers said, quote, "In the last 4 years there have been cumulative reductions on average of 20%, and it has been possible to secure a 50% reduction." He said that when Tolley came into the room, quote, "he got together the P&I underwriters. He tried to knock heads together, saying you have to get your act together or we may control the amount of capital allowed into the market." So, says Villers, listen to this, "underwriters will be asking more questions about the risk, and it will be up to insureds to show that they're better than the rest of the pack if they want to minimize any increases." Villers also warned of increasing claims across the P&I sector. He pointed to the Lehman Brothers collapse, saying that the majority of its D&O program was underwritten in London, with the insurer considering the whole $200 million in insurance a total loss. Of course, yesterday we reported the possible beginnings of a new tidal wave when MBIA sued Countrywide over alleged misrepresentations in the mortgage bonds that Countrywide had MBIA insure. Countrywide has already received about $450 million in claims from MBIA that MBIA wants back. Stock market is still up over 200 points. We'll go to a word from our sponsors.
Every day, the world wakes up and goes to work, pursuing the unique opportunities that lead the global economy forward. The complexity and close connectivity of today's global marketplace is a true modern miracle that can create unparalleled success. But it takes